¿Me escuchan bien? Can you hear me well? Hello, everyone.
Hola a todos.
Hola, ¿me escuchan bien?
Te escucho perfecto, Marcelo. ¿Tú me escuchas a mí?
Perfecto. And you, Tommy?
Perfecto.
Excellent.
Great.
We are fine.
Hola a todos los que están conectados. Vamos a dar unos minutos antes de comenzar con esta sesión, así que les agradecemos esperar con nosotros un par de minutos más a que lleguen más personas. Bueno, ya tenemos más personas conectadas. Antes que nada, un cordial saludo de bienvenida para todos desde donde nos estén escuchando. Bienvenidos a esta sesión de hoy de Venture Academy. Como saben, esta sesión será en inglés. Y bueno, les cuento un poco de Venture Academy para los que nos están acompañando por primera vez. Venture Academy es un programa desarrollado por XCALA, BitLab y ConnectaAmericas para capacitar a las pymes, startups e inversionistas de la región en temas de emprendimiento y levantamiento de capital. Así que antes de empezar, quiero darle la bienvenida también a Marcelo Roca para que él nos dé unas palabras y nos introduzca con el especialista que nos acompaña el día de hoy. Muchas gracias a todos por estar acá y thank you, Mr. Davies, for being here with us as well. Así que, Marcelo.
Bueno, muchas gracias, Manuela, por la introducción y todo el apoyo que nos estás dando en Venture Academy. La verdad que es un placer poder trabajar con ustedes. Quiero aprovechar para también agradecer al BitLab, a ConnectaAmericas, por hacer que Venture Academy sea posible y le damos la bienvenida a toda la comunidad de Latinoamérica y del Caribe y desde donde se están conectando, que entiendo que también hay gente que se está conectando desde Nigeria. Les voy a contar un poco cómo va a ser la metodología. Vamos a tener aproximadamente 45 minutos donde Tomi va a estar dando una charla en relación al tema que va a estar tocando hoy. Después vamos a recibir algunas preguntas, vamos a reflexionar sobre algunos temas. Así que los alentamos que en el chat puedan escribir justamente todas esas preguntas, todas esas reflexiones, que nosotros las vamos a ir tomando y las vamos a dejar un poco para el final. ¿Bien? Hoy tenemos el gran honor de tener a Tomi Davies. Tomi Davies, como les decía, está en Lagos, Nigeria. Es un inversor ángel, es presidente de ABAN, que es una asociación africana de inversores ángeles, muy parecida a lo que hace XCALA en Latinoamérica, y nos va a estar hablando de un tema muy importante que tiene que ver con una metodología que diseñó, que se llama el POEM Framework, y que básicamente la utiliza para entender si efectivamente los emprendimientos que se les acercan tienen el potencial como para recibir inversión y están justamente en esa instancia de recibir inversión. Así que bueno, ahora lo que hago es I'm going to switch to English to welcome Tomi Davies. Tomi, it's a great pleasure to have you here with us at Venture Academy. Thank you for sharing all your thoughts and knowledge. And well, the webinar is all yours, okay?
Thank you very much, Marcello, and thank you, everybody, for being here today. If I can get the technology to work in my favor, we will be talking about building investment-worthy startups. And a little about me. My name is Tomi Davies. I am an advocate of the African early stage entrepreneurship ecosystem. But the reason I'm talking to you today is because I'm an angel investor with a growing portfolio of early stage ventures on the continent of Africa. Those in parentheses I have left up there, those are the ones that have either failed or are no longer in existence. But I do have a thriving portfolio. I am a co-founder, as Marcello said, of the Lagos Angel Network. I'm also the president of the African Business Angel Network, and I'm a board member at the World Business Angels Forum and at the Global Business Angel Network. So I trust that credentializes me enough to talk about what we're going to be discussing today. So the first thing is we'll sort of go through some definitions so that we're all on the same page. Then we'll talk about what the ideal founder looks like to start a successful startup and why the vision is really very important. We'll then look at startups and how they're different from small to medium enterprise in terms of growth, funding, and the concept of exits right from the beginning. We'll talk a bit about my friend David Rose's startup investment portfolio theory and look at the different startup investment stages. That'll give us the background we need to actually take a look at my poem framework and understand what we mean when we talk about the fact that it takes a poem to bring a vision to life commercially. After that, we'll look at the startup scorecard and how we do assess startups using this framework. And I'll go through a case study so that it brings everything to life. I hope you find it useful, and I'm just going to go straight ahead. If that's okay, Marcello, may I?
Yes, it's excellent.
Fantastic. Okay.
So right. we are seeing the presentation very well, so you can go on. Thanks.
Fantastic. That's the feedback I was looking for. Okay, so some definitions. First of all, I've said I'm an angel investor. What does that really mean? It just means it's an individual that's actually investing their own cash into startups. They're investing their own time into startups. They're investing their own connections into startups. And most of us are growing up now to do this through the growing number of incubators, accelerators, and hubs that we find available on the continent, because that's where the startups get educated and get built. And I'll talk a bit more about that as we look at the incubators and hubs themselves. Well, they're actually a fun place to be. Okay, that's where imagination meets execution. That's where startups come to life and are created. The things that people like myself as angel investors and venture capital and other people are interested in, that's where we see the engine being created. And a little bit about venture capital. The difference between venture capital and angel investing is venture capitalists are actually licensed professionals who have aggregated other people's money to invest. And that's a big, big difference you need to understand in terms of the context in which I am talking about startups and everything we discussed today. So what's a startup? Well, it starts with the person that actually founds it. They're called a founder. Okay, and I say founders need to be executioners. They need to be able to execute to plan. And typically, we're talking of a visionary person that has that capacity to actually bring their vision to life within the context of actually creating the startup and having a very good perspective about that. We're talking of a passionate individual who's knowledgeable about how to run organizations and is quite aware that, look, I don't have everything it takes, but this is where I get it and this is what I'll need. So they have that capacity and that capability. You're talking of a manager, somebody who knows what the roles and responsibilities for everybody within the organization should be and who should be doing what, when, and how, to a very fair understanding of that. You're talking of an executive who understands what is required in terms of an advisor as opposed to a director of the board of the company, and understanding which expertise and which experience gaps the venture itself has and therefore needs to plug through these roles. Finally, and probably most importantly, we're talking of an emotionally intelligent, self-aware individual, okay, with challenging yet realistic goals. So that's the kind of person, I'm quite sure, as I've reeled through this, you're starting to go through in your mind, I can see this in that entrepreneur, in that person. That's what we're talking about. This is sort of the framework of a founder that is ideal. Now, I say it starts with the vision because to start and sustain a successful startup, just like any other business, because it is a business, you need to have a compelling vision. That vision is what is going to drive the execution of the creation of it. We're talking of measuring the startup as it progresses towards the achievement of that vision. And that's really what the life of the startup is. It's that journey, okay? When you say paint me a picture, it is that journey that the founder wants to go on that we all buy into. And that's what we're hoping actually happens in terms of getting the kind of rewards from that journey. And because angels, VCs, hubs, everybody interested in it, okay, is there for commercial purposes. This is not about charity. This is about making money. This is about building a money-making machine. Now, if you're going to build a money-making machine, there are specific things we need to focus on. Two critical things on how you do them. The first is how your products and services make money. Numero uno. How does this thing make money? And who is the money coming from in terms of the customers that actually find value in the offering? It is fundamental and inviolate. Without it, you don't have anything. That's the first part of the engine that makes money. Once you're clear on this and we know how you're going to do that, second thing we want to know is how are you going to deliver this product service offering that satisfies the customers? How exactly are you going to deliver it? And I'm going to harp on these two components a bit more as we go further along. But remember, the product service offer, how it makes money, and the delivery, how it's executed. Two components, very, very important, coming out of the founder's vision. So let's talk a bit about startups. Startups are built for rapid growth in extreme uncertainty. Okay, they're entrepreneurial ventures, very early stage. They're bringing to market an innovative product or service, okay, that actually meets a specific need, okay, or has demand. Now, startups are different to traditional new small business ventures in at least three critical ways, okay? The first is growth, the second is funding, and the third is exits. Let me explain what I mean. When we talk about startup growth, in comparison to traditional business ventures, startups in Africa, especially my home country, Nigeria, for example, at their growth stage I'm expecting to see anywhere from 10 to 20% month-on-month growth. If you're telling me you are really in growth, that's how I know you're in growth. And that is what we expect of startups. SMEs are not looking for continuous growth at that stage. They're looking for steady Eddie growth. The second is funding. Now, if you have an SME, then you have a known risk profile. You can take your business plan and get a small business loan from a bank or from other non-governmental institutions to do what you need to do. Startups are building something that's not been built before. It's trying to sell to customers that people don't even know exists. And that's where angel investors and venture capital make their money. So if you look, for example, just last year, 1.3 billion was invested in African startups. This year, even with coronavirus, we've seen an inflow of about $400 million going into African startups. So that's the second component of where the startups differ, is this access to funding that they have that is not necessarily available to SMEs. The third and final is exits. And I thought with exits, you know, you've heard me for a few seconds now. Let me share my story with you. In 2001, my friend Oliver in South Africa started a comic, which I put $5,000 in. And that year in Nigeria, we started to distribute the comic. And we started to grow it and develop it and build it in such a way that by 2008, Media 24 came calling and wanted to acquire majority shares of the company. Guess part of whose shares? They bought half my shares, and guess how much I got for half my shares? $250,000. Now, isn't that an amazing exit for an angel investor? Well, don't forget, I still had half my shares left. So at that time, we started doing animations, and by last year, we were doing 30 million views on YouTube as an animation channel. So Moonbug, the predominant player in the sector, came along and they wanted an acquisition of Super Strikers. We didn't know why, but we were happy. Hey, I'm happy to exit. And guess what? I walked away with another $250,000. So I've done 100x on 5,000. That's the dream of angel investing. Now, a little anecdote to this particular story. Just in March, Moonbug sold Super Strikers to Disney India. I don't know for how much, but I know they didn't lose money. So that's what we're talking about here. This is about making money. And that's why angel investors do it. So let's look at investing in startups and what it really means. My mentor and friend is David S. Rose. He wrote the book on angel investing, and he's a founder of the New York Angels. Now, David says that there are 5 startup truths we all need to know. The first is that most startups fail. And if you remember when I showed you my portfolio, remember those in parentheses? They failed. That's the reality of this space. The second is, now, no one, absolutely no one knows which startup is not going to fail. And I could tell you a thing or two about that, but, you know, let me move on. The third thing is, and you saw, I think maybe 19 or 20 of my startups I presented there, it's a numbers game. This is not about putting money in 1 or 2 startups. It's about 5 or 10, 15 or 20, okay? In fact, law has it that, you know, 20 is probably the minimum you want to go if you're planning to do this properly. And I'll talk a bit more about this. What ends up usually went down first. You can't make money without having lost it, but we'll come back to that. And this one is one of the truisms I've come to find out. Startups will always need more money. If they're going to keep climbing that curve, they'll always need more money. What does that mean? Well, startups grow in what we call investment stages. It starts with pre-seed, when it's just an idea in the founder's mind and he's trying to even get something on paper and find and enthuse some of his friends and do some stuff there. At that time, it's probably personal savings, family, friends that are contributing a bulk of the money. Increasingly, we're starting to see crowdfunding platforms that are playing in that space. But until he actually gets something we call an MVP, minimum viable product, which is he starts to get revenue, starts to get money from customers, that's about the time we talk about seed investing. It doesn't really count. And even at the beginnings of revenue, we still have something we call the valley of death. And if you remember, Dave said what goes up, went down first. This is exactly what he means. So most startups will go through this phase, and it is as they come out of the valley of death that angel investing kicks in. And then you see venture capital and quite a number of others start chasing, okay, the obvious growth that is occurring in terms of funding. So those are the investment stages that a typical startup will go through, noting that it's not about the timing, because it may take a while to go through it. There isn't a set formula for financing a startup. In fact, the number of investments, the amounts you raise, time between rounds, the number of rounds, it's going to vary from startup to startup. And the key thing is, it's going to depend on so many different factors that influence it. From the stage of investment it's in, what market, what microeconomic, there's a whole bunch of parameters that go into this. But generally speaking, startups will pass through 5 investment stages. The first is what I identified earlier, pre-seed ideation, where they're thinking through it and everything else. While crowdfunding is there, some angels will play in this space. At that time, the investment is actually betting on the founding team. Okay, any pre-seed ideation, because you don't have anything to, that bets on the fact that these guys can actually execute. Remember what I talked about, the founder being an executioner. This is when it really, really comes to life and counts. By the time you're getting to seed stage, you've got customers going, then the bet is actually that you have a product service offer that the market wants and is going to help you find product market fit. So you get to growth stage. The investment then is on the fact that, yes, you do have this 10, 15, 20% month-on-month growth, and you can then sustain it over a period. That's where the investment bet is going. On scaling, at that time, you're betting on the fact that they've got the unit economics right. They know what they're doing, and things are going to go gangbusters. By the time you're in the later and pre-exit stages, you're only looking at valuation. How much is this thing really worth, and how big can it grow? That's where investment focus is. So as we talk about assessment and building investment-worthy startups, these are the critical things to think about, whether you're building or you're investing in startups. So, question for the audience. Marcello, please look at the chat and see if anybody puts in, what stage is your startup? Are you at ideation or just thinking about it? Are you at the startup stage where you do have some customers and you're trying to get repeat customers? Or are you at growth where month on month your revenue is piling and you're having to find people? Or have you passed that and you're scaling and starting to look at how you do new markets? None of these are time bound. It could take weeks, it could take months, and in some cases it takes decades. But the thing is, there is a model and everybody goes through it. How quickly they go through it is what we're talking about. And that is where my POEM framework kicks in. POEM says that for every commercial vision, there is a proposition. Remember we talked about the product offer, the product service offer earlier being one of the critical things that made up business. And for every proposition, there's an organization that delivers it. And we said the second component was the delivery. So those are the 2 fundamentals that come together in this framework. But what we then say is that there are 2 measures of the proposition and organization. The first is an economic measure, which is the funding and finance. And the second is a measurement of time, how they progress towards the vision in time. So that's it simply. It says for every vision, there's a proposition to the market, which is delivered by an organization. It has an economic measure over time. And that's the POEM framework in a nutshell. Now, let's look at what it means in detail. So when we talk about the proposition, for example, we're talking about what's the target market? Okay, what's its size? Okay, what percentage share can you really get? What's inflation doing to that market? What are the demands? What are the demand curves? What are the trends that are prevailing in this particular market that this startup has chosen? What segment is the offer for? And what are the customer profiles looking like? So how are they going to do product service development? Is that been thought through? What are the functions and features that they have already seen value in? Then when we start to look at demand again, what kind of benefits do the customers get from this particular product? And what is the offer itself in terms of pricing? remembering that critical radio station that all of us love to listen to and nobody ignores, WIIFM, the world's favorite radio station. In case you don't know, what's in it for me? That's all the customer wants to know. What do I get out of your product or service? Then, of course, we've got to think through and assess what's the competition? How strong are they? What are the alternatives to this product or service? Are there substitutes in existence that will challenge it? And what kind of differentiation is it really, really bringing to the market? You also have to look at rules and regulations. What are those that apply? Is there licensing requirements? And how does compliance happen? Finally, you look at the value chain from an inputs and dependency standpoint to really, really understand, okay, what the proposition is like. And remember, we talked about stages. So if you're at stage 1 in ideation or seed, I'm expecting you have a defined concept that we can hang a hat on and, you know, we can go and walk around, kick its tires, and we know how it's going to make money. By the time you're at startup stage, you've got to have an established customer offer. Let me see a few of your customers. If you're B2B, let me talk to 5 of them. If you're B2C, let me talk to about 50 of them. You've got to have that in place, and that's what you're building to. If you're at growth, I want to see those numbers in the market share. That's what's supposed to be happening, and that's where the focus is supposed to be when you're in growth. If you're scaling, well, what new markets are you looking at? Or what new products are you looking to build for your market? That's the conversation on proposition. If you're at the later stages, well, then, you know, you're talking of a whole different ballgame, new vision and everything else, and it's really beyond my personal scope. But when we start to look at the organization, knowing what the proposition to the market is and what stage it is, then the organization is what delivers that value proposition to the customer. So we look at the people, shareholders, the board of directors, management, the staff, who are they, you know, who are the partners. Then you look at the processes. How are they buying? What are they using to make? How are they selling? You look at the fundamentals. In my case, I only do technology enabled. So I also kick the tires of the technology, want to understand what's the base infrastructure, what's the applications, and what's the communications infrastructure required in between, and how are the messaging occurring. So these are things you look at so that by the time you're in ideation or stage, I'm expecting to see a team with a business model. If you say you're a startup, then I want to see an operational delivery structure that actually knows how to put your product service offer in the hands of your customers. If you're getting to growth, you must be having traction. That means everybody knows what they're doing and they can do it every day or night you require. By the time you're scaling, your processes are repeatable. That means you can transfer them across geographies without any problem whatsoever. At late stage, well, you know, you're a market leader. So, given these expectations of the proposition and the organization, what does the economics look like? Well, first of all, this is about making money. So I want to see your profit and loss. No matter how bad it looks, okay? Do you have a P&L? What does it look like? What's your current financial position? Let's look at your cash and who owns the company. Then what are your forecast assumptions and how have you actually performed against that? Then we talk about things like burn rate, how much you're consuming every month, runway, how much cash you've got left, your month-on-month growth rate, which we talked about earlier, and then, of course, the standard investment, things like return on investment, net present value on, you know, cash you've taken on before, and the internal rate of returns that you're expecting. But really, the economics actually measure financially the value you are creating. So at the ideation, at the beginning ideation and seed stage, of course, the money is going to come from the 4 Fs, you know, the founders, the friends, the family. And I say fans, not fools. You're going to get grants and prize funding. That's what I expect to see. But, you know, at that stage, again, you're probably not burning much. By the time you get to startup, you have a steady burn rate. You still got family and friend chipping in. But this is where angels come in. And this is where early VC also comes in. By the time you're in growth, I am yet to find an angel that wouldn't, you know, jump in on a growth cycle. VCs also come in at that point, and that's why it tends to be at that stage, depending on size, market, and a whole bunch of parameters, break-evens is sort of the financial target, because by the time you get to scale, you're looking for unit profitability. And of course, late pre-exit, that's all about, being self-funded. And again, like I said, beyond my personal scope. Now, those are the financial measures as the startup builds itself along. And in terms of what it expects to achieve at seed stage, well, MVP, minimum viable product that attracts customers, and that tells you that you have a market. By the time you're a startup, you're trying to ensure you get to product market fit. Product market fit is not a singular occurrence, it's a set of capacities, capabilities, and results that tell you that your value hypothesis, which is the underlying phenomenon behind your product, okay, is actually valid. That's what product market fit is. At growth, you're looking at how you sustainably manage growth. How do you sustain growth, and how are you managing that? That is what the expectation of that milestone is. By the time you scale, we talked about it earlier, okay, it's about how you aggressively approach new markets and new products if you are going in that direction. And at late pre-stage, it's about how significant your valuation can and cannot be. So how do we assess these things? Well, we've got a systematic collection and analysis mechanism for investment readiness using the POEM framework. It's an investigation method into the vision, the current status, practices, processes, and policies. It's actually like an examination, for the want of a better word, aimed at giving information so that we can decide to invest, because our investment is not just cash, it's also time and connections to our business networks. And these are very, very detailed. It's about measuring those stages I've talked about over a period of time. So how do we do that? Well, we've got a scorecard, and the scorecard, what it does is it looks at the proposition and says, well, you know what, is there market strength in this proposition? How do we know? Well, first thing we're going to look for is, do they have a strong product service line? If they do they have a unique competitive advantage? And how unique is that advantage? And then, is there a positive market growth rate? Because this is not just about them, it's also about the market in which they're finding themselves. If you've got a tick on all of these, then the next thing to do is look at the organization. Now, do you have the depth of management that's going to allow you to actually capture this value in the market and deliver? So you look at the entrepreneurial vision, you look at the ability to execute, and of course, you have to look at access to resources. Once you're comfortable with these two, then you start to look at the economics to see if your financial returns can actually come true. First thing you want to know, are they going to make money? Do they have satisfactory revenue strengths? Is there a credible future profitability, even if they haven't achieved break-even yet? And then, are the cash needs they have acceptable? If you're happy with that, you then need to look at how they're progressing in milestones. So what's your exit potential if you get in now? You want to look at, are there exit routes? What's the next phase for this thing? Okay. Are there feasible follow-on investments? Remember, startups always need more money. And finally, do you have a satisfactory exit value? If I put my money in, can I get 5x? Can I get 10x? If the proposition is strong, the organization is strong, the economics is strong, the milestones are strong, then that's when you invest. And what does that look like? Well, here's one we looked at last October, and you can see, okay, it's a fintech early stage 2, and you can see all the assessments, but I'm not going to bother you with the detail. I just want you to look at the good exit routes of feasible follow-on investments. You'll see a 0 and a 4. That tells you where they're weak. So it says the best angel fit for this is somebody who understands how to develop exit routes for a startup. Because if they go into this startup and can raise those numbers, guess what? The valuation of this startup is going to be good and they're going to make some money. So to cut the long story short, yes, we did do the deal and we're working on it. Thank you very much for listening. Your feedback is very important. I'm more than happy to take questions.
Well, thank you very much, Tomi, for sharing your thoughts with us. Very nice approach, the POEM framework that you developed to assess new ventures. I took here many notes. We have many questions. So let's start with your story that you told us that you made 100x of return over investment in one of your investments. So which was your involvement in the company? It was just cash, or I mean, have you provided smart capital, connections, networking? Just enlighten us about this issue.
Okay, all of the above. First, I did provide advisory at the beginning, but probably even more importantly, I did the recruitment of the team. So the team in Nigeria was personally recruited by myself because Oliver was in South Africa. I also helped them with finding offices, raising the initial cash to get the operation started in Nigeria. All the usual things you expect an angel to do. And of course, mentoring the first one. In fact, all the chief executives, all the country managers in Nigeria have been mentees of mine.
Excellent. I know you are involved in ABAN and on World Business Angel Investment Forum as well. So maybe you can have some idea of how African startups compare, for example, with European startups, or maybe USA or Latin startups. So maybe you can give us some reflection and clarification on this issue.
Well, I think there are three distinct differences, okay, but there are also similarities. Okay, the first is scale. Market scale, size of market. Unfortunately, people tend to think of Africa as one monolithic market, and we ourselves probably contribute to that myth, but I'll come back to that. The size of the US market alone is bigger than that of any European country. In fact, we tend to compare the United States with Europe, rather than United States with a single. So the scale of the economies is what I'm trying to get at. There's a fundamental difference in scale, in sheer size of the European economy, the American economy, and the African economy. Yes, when you look at it, for example, I said $1.34 billion was invested in startups in Africa last year. But guess what? Of that 1.34 billion, over 400 million of it went just to Nigeria. You get the point I'm making. So yes. You've got Nigeria, you've got South Africa, and you've got Kenya, okay? And then you've got Egypt as sort of the big four.
So we can say that most of the angel investment and maybe venture capitalists of Africa are based on Nigeria and they invest down there. That's correct?
Well, no, they're actually based in Cairo Angels, Egypt, Lagos Angels, Nigeria, Victoria Angels, Kenya, and then Josie Angels and Dazzle Angels, South Africa.
Okay. Excellent. Well, in your presentation, you talk about like 4 stages of development of the new ventures. I'm gonna focus my attention on number 1, which is the idea or ideation. You told us about it. So you told us that at that stage we need, or we must have a well-defined concept, a team, and an MVP. Okay. First, to clarify the audience, what do we mean by an MVP? It's basically an experiment that we perform in order to validate our business opportunity. Okay. So, do you believe that the MVP strategy may be applied on any industry, or this is only true on technology ventures?
Well, let me let me rephrase that to shade MVP as I see it, because the MVP just says, I believe that if I create a product that has these functions and features, okay, and has these things, I believe that customers that have this kind of profile, okay, will use this business model to buy it from me. So there are three components you're looking at. Okay, the first is the construct of the functions and features that make up your product or service. The second is the behavioral dynamics of the customer that is going to see value in this product or service. And the third is the business model that allows for the exchange of value between the two. An MVP is a validation of that value statement.
Okay.
That's all it is.
Okay.
Does that help?
Yeah, sure. So basically, it applies to any industry, to any business. You have to be as creative as possible in order, to create a cheap experiment to validate your business opportunity.
Well, the thing is, it is for innovation. That is the purpose of the construct, purpose of the model is innovation, because it's like people were saying, Steve Jobs just invented the AirPods or the iPod without knowing. People don't know what they want sometimes until they see it.
Okay, excellent.
Yeah.
So tell us about your failures as an investor. Which were your learnings? What you make different once you fail as an investor?
Mm-hmm. Oh, well, I think I used to have a set of slides that show this. And if you Google my name and you look failure, you'll be able to find. I invested in a startup, fine young man and his partner. I met his parents, took the time out to get to know them. They were still in ideation. They didn't have customers, but they were testing, the value proposition on the market. And they did quite well with some of the tests, to the point where I got them into an incubator.
Okay.
The incubator also then, of course, invested some money into them and started working with them. I actually live in the UK, although I frequent Nigeria. My base is Nigeria. So I remember coming back one particular trip and asking for this young man, and he disappeared. Quite literally. Okay. 2.5 million naira is, I don't know, maybe $10,000, $15,000 up in smoke. So that's one bad one. The second one is actually a startup that did exceedingly well the first couple of years. And, the first round I did 25K. They really grew gangbusters, did a round of 300,000. Then the next round did 500,000, very, very successful. They went into 3 countries. Then they hit a rock, is the only way I can describe it, because the next round was supposed to be 5 million and it never went. And they choked and ended up being split into pieces in what we call a fire sale. And I think I put in $60,000 on that one, and I got $600 back.
Okay. So maybe one of the things to take in consideration is how difficult it is for entrepreneurs to raise money. Mm-hmm. So if they do not have the ability and the funding
in subsequent stages, exactly.
Because if we are talking about, Silicon Valley, there is a huge amount of money down there, but in Africa, in Latam, we have to, it's really difficult, to raise funding, I don't know, from angel investment, from Series A, and so on.
Yeah.
So
the third and last story I want to share, just to bring it to life, because angel investing is about building relationships with your founders. I had a startup that I invested in, and they were in growth. In fact, they were doing 20 20-25% month-on-month growth. One day I got a call that unfortunately the 26-year-old founder passed away. That was it.
Okay. Well, so that is something that you cannot control. So
exactly. So that's why you do not know which one is not going to fail.
Okay. Well, let's move to the second stage. You talk about the startup stage. I mean, you told us, and correct me if I am wrong. You must have an established product or service. Okay, number one. You must have an operational structure to delivery, basically people, technology, and processes. It's the time when angels start to believe in your company, and you can have a closing event. And you must have, you told us, and this is key, the product market fit. Okay, so basically a product or a service that is accepted by the market, hopefully a big market, and repeated customers, okay? So how do you measure that product market fit? For example, I don't know, percentage of repeated customers, how big must the market may be? Yes, how you measure the product market fit? It's the question.
Well, it depends. Let me say it depends on who you talk to. Okay, because there have been different, how do I put it? Different approaches too. But product market fit is when, remember I was talking about the triangle earlier, your value proposition, the customer segment, okay, and the business model. Now, if you break the business model down into a relationship and a channel, okay, when those things are aligned, and there are ways to measure it, okay, so if you go online, and like I said, my background is technology, so in a technology environment, if you want to measure specifically, the first thing is you do customer surveys, and 40% of those, there's something we call the 40% rule. 40% of your customers must say that your product is a must-have, or I must have it, okay? Or I will be disappointed if I did not have this product. So there's that 40% rule. But online, we look at things like bounce rate, time on site, pages per visit, returning visitors, and most importantly, customer lifetime. Again, like I said earlier, it is sort of like one of those things where, I know an easy analogy. You know, when somebody says, what's pornography? You say, I can't describe it, but when I see it, I know it. And it's the same thing about product market fit. You will know when you've got product market fit because all of a sudden things just click in place. Okay, why? Because your value hypothesis would have been proven. You know why customers buy from you. Why? Because you made a hypothesis when you were looking at your MVP that these kind of customers who have these kind of needs will see value in my product, okay? And they will be prepared to part with money under these terms for my product or service offering. All of those things just click in place in terms of your hypothesis. And that's what product market fit is, okay? Is the fact that there is a market, okay, that will take as much of your product as you can produce.
So that is the timing when you are able to validate your hypothesis, and it's the time when the angel investors and maybe some VCs would invest in your opportunity to take it to the next level of development.
Correct. Spot on. Spot on. In fact, the angel quest is to identify startups, okay, that have product market fit before they know, so you can invest.
Excellent. Well, suppose let's suppose we are not friends, okay? I am an entrepreneur with with a very nice opportunity. I believe it's gonna change the world, okay? So how is the best way I can approach you as an angel investor? Assuming we are not friends and this is the first time we are talking.
Okay, it is to identify what you need from a capacity standpoint, not financial. Are you looking for somebody who understands the telecommunications market and can help you with licensing? Are you looking for somebody that has done food distillation in a grocery setting environment before? Are you look for things outside of cash, okay, that would add value to your startup? That's the start point.
Okay, but how the interaction works? For example, suppose we have a number of people down there on these webinars that maybe want to meet you, want to send you a business proposal. They want to raise money.
Angel investing is a local sport.
Okay.
It's a very local sport, and I am from that school that disagrees with those who say, oh, we should have cross-border angel investing, the way they're proposing it. Let me explain. The value of an angel investor to a startup should not be cash only. The value of an angel investor to a startup starts with the experience, the expertise, and the connections that angel can use to mentor and advise the founders of the startup.
Okay.
That is the ideal situation. Anything outside of those parameters skews the story.
Okay.
So that's sort of the first thing.
Okay.
Most people ask the funding question where it would apply more to venture capital than to angel investing. If you consider that angel investors are investing their own money, they want to be close to where they can assess and they can add the value. That is why it is a city-based sport. So it's not even for everybody. It's a Buenos Aires Angels, because you have people that know Buenos Aires and therefore know how the rules work when you want to create your business in that environment. And that is the value they are bringing to you.
So I may add, it's business, it's money, but angel investment, it is also a chemistry that we must have in order, to
correct
move forward.
Yeah.
We are gonna see each other many times. We are gonna, discuss about business.
The process I use now is I have an annual entrepreneurship mentoring scheme.
Okay.
So every December, I take on 25 new entrepreneurs for a year to mentor them throughout the year. Those I have mentored then the ones that qualify will move to advisory, where I provide advisory services to their startup for another year. If I am happy that they have scaled those two, then my syndicate, the Technovision syndicate, there are 20 of us, have right of first refusal to invest in any of them. And once the syndicate has invested, then the network is next. And after the network...
So you are the one that filters the good opportunities, and you are kind of a lead investor in that syndicate.
For my own startups, yes. There are others that lead other deals too.
And depending who leads the round, that depends on the knowledge of the investors?
Correct.
Okay.
And no, it depends on, not the knowledge of the investors. It depends on the investor's ability to add value to the startup.
Okay.
Yeah.
Excellent. Well, let's move to the scale stage, okay? You told us that here is the time when you start to add new products, okay, number one. Maybe you can go to new markets as well. You are
or the other way around.
Or the other way around. You maybe are starting to be profitable, maybe reaching the break-even point, and maybe as well is the time when you start raising Series A investment, okay?
Correct,
This
yeah.
venture capitalist, okay? So I understand that you help your entrepreneurs to raise capital in other rounds. So you have also, that dynamics with the venture capital industry. So which are the key aspects that the venture capital will take in consideration in order to invest in a scale stage venture?
If you quote me, I'll deny it. Venture VCs are spreadsheet jockeys.
Okay.
They live on Excel spreadsheets.
Okay. Have you seen any VCs that it's not passive, that they participate as well with this smart capital, with their connection?
Oh yeah. Oh no. Yes, definitely an increasing number. So we have VCs that are going into what we call venture building now. Okay, so if you look at Future.Africa, you look at Green Tech, those are a couple of, what they do is they go in and say, okay, you're in the growth stage, we're going to take you to scale. And the way we're going to do that is, it looks like your chief operating officer doesn't have a product development manager. We'll give you a product development manager that will build that out until you can hire somebody. It looks like your marketing isn't doing as well. We're going to fix that. And by the way, it looks like you probably need another 50 grand in cash flow. We'll put that in. And for all of that, we're going to take 11% of your business.
Okay.
So there are those doing that now.
Well, Tomi, we are running out of time, but I have to ask finally about the coronavirus pandemic. So which are the sectors that you believe represents the biggest opportunities right now with this pandemic issue?
Well, it's funny. The death of air, but the rise of logistics. So transportation. Okay. Transportation, the change in transportation. So we're going to see more and more as social distancing becomes the norm. Okay, we will see a lot of logistics delivery capabilities rise. That will be sort of the first thing. All the providers of online infrastructure, we've seen Zoom and others win. There's no doubt that will continue because the airline industry isn't coming back anytime soon.
Okay, well, excellent. Thank you very much, Tomi. It was great to have you at Venture Academy. Some of the people that are listening are asking for your contact information, so we will send.
You find me on Twitter. You find me on LinkedIn. You find me on Facebook. I'm all over social media. Tomi D, TOMIDEE. I put it on the last slide.
Excellent. Well, thank you so much, and I am switching to Spanish to do the closing.
Me gusto mucho. Gracias.
Well.
Thank you very much, Mr.
Bueno, para cerrar, comentarles que la semana que viene seguimos con Venture Academy. Vamos a tener a Israel Pons desde México. Israel es un ángel inversionista y es director ejecutivo de Angel's Nest. Y nos va a estar hablando cómo armar una cartera de inversión para aumentar, obviamente, las chances de lograr buenas inversiones, buenos retornos y rentabilidades. Así que bueno, el horario el de siempre, los miércoles a las 12 horas Eastern Time. Así que bueno, muchas gracias y la dejo a Manuela como para que pueda hacer el cierre.
Muchas gracias a todos por habernos acompañado en esta sesión de Venture Academy. Estuvo muy interesante. Thank you, Mr. Davies, for all you shared with us. We have a lot of good comments, and we hope to have you back on a webinar on ConnectaAmericas.
Thank you.
So thank you very much all, and hope to see you next week.
Well, bye-bye. Take care.
Bueno.
Ciao, ciao.
Ciao, ciao.